Yeah, hi everybody. It's Saturday the 3rd of October 2009. It's late on in the evening, and I just want to say the people have spoken, and the vote for this Lisbon referendum has been carried, and it's a big, emphatic yes vote, and I don't agree with it, I don't like it, but I'm a Democrat, and I accept it, and I have to move on. Someone sent me an email. One of the subscribers a few days ago, and I didn't get a chance until this afternoon to have a look at it. It was out of an article from the Irish Times by one of their financial correspondents, a fellow called John McManus, and I'd have to investigate it more because I was staggered when I read it. I was truly staggered. And I think what I'll do is I'll have to read it out to you because and then we'll just have to try and explain it because it's a bit complicated. But I think I'm reading it. I think I'm reading it the right way. It's the only way I can read it. You can only read this one way from what I can see. And it's from. I'm going to put the link up and you can have a look at it yourselves. It's from Saturday, September the 19th, and I got the newspaper that day. I got that Irish Times that day, and I don't know why I didn't read this, or if I read it, it didn't have the input. It didn't have the necessary input, but it does today when I read it. Anyway, listen to this. It says the ECB funding 25% of Irish deficit indirectly, data reveals, and the ECB is the European Central Bank. John McManus says the European Central Bank is indirectly funding about a quarter of the Irish government deficit according to central bank figures. It's our central bank figures. Irish central bank figures. The data shows that Irish banks have availed of European Central Bank support to purchase almost 7 billion, that's 7,000 million, worth of Irish government bonds since last November, when the National Treasury Management Agency stepped up its borrowing programme. It says Irish banks account for 26% of the 26.3 billion in debt issued over the last 10 months by the European Central Bank. So the European Central Bank issued 26.3, and we took up, the Irish did, we took up 7 billion of that. Okay, just listen to this. The banks are able, that's our banks, our retail and commercial banks. The banks are able to purchase the debt by borrowing from the ECB, the European Central Bank, at a rate of 1% to buy Irish bonds, which pay about 5% per year. They have been allowed access to unlimited European Central Bank funding lines to purchase bonds as part of the emergency liquidity measures introduced in the wake of the crisis in world credit markets. Under the European Central Bank refinancing operations, the Irish banks must first purchase the Irish bonds, usually with short-term financing. That's only an aside. To do that out of their own funding, they could do that for a day or 2 days, whatever. Once they own the bonds, they then have the bonds. Okay, they bought the bonds. They can then refinance them at the European Central Bank. That is, get cash by putting the bonds up as collateral. The final part of the process is to repay the original borrowing. It says the ECB is forbidden under its own rules to lend directly to member states, as this would be the equivalent to printing money to fund the government deficit. However, the current system under which Irish banks are borrowing from it at a low rate in order to lend to the government at a much higher rate in the form of bond purchases is tantamount to lending directly to the government, market sources claim. It says the National Treasury Management Agency did not return calls yesterday. You can have a look at this and read about it yourself. Now, the way I see this is, if I'm reading this correctly, there's three parties involved here. There's the European Central Bank, there's our banks, and there's our government, represented by our central bank. Okay? So you've got European Central Bank, our central bank, and in the middle we have these banks, our commercial banks, retail and commercial banks. Okay? And what's happening is they're going along, our government, they're buying bonds from our government, which pays 5% Okay? And because our government can't lend directly to the central banks, they're doing a switch. And what happens is they're buying the bonds, as I say, which pay 5% from our government, lodging them with the ECB, European Central Bank, and the European Central Bank are giving them cash up front for the bonds. Okay? And charging them 1%. Now you have to work that out. It's very, very simple. What's happening is the Irish banks are getting a tax-free loan of 4%. And they're getting it not from the European Central Bank, they're getting it from our central bank. So our central bank is paying these Irish banks, if they borrowed, it says they borrowed 7 billion, which obviously they give to the government. The government has the money for the bonds, okay? That costs 280 million euros every year. That's $250 million monies, euros, that we, the people, are given to our banks every year while those bonds last. And this is an ongoing process. This is just an ongoing process. This is unbelievable. This is unbelievable. I have to find out the figures for this, because this is just incredible. Do you know, if you buy a government bond and attached to it are what's called notes, and they pay these notes, say if it's a 5-year bond, there'd be 5 notes attached to it, and what you do is you cash in the notes, and on the 5th note you get the capital back, right? If you want, or you can roll it over and you get another set of notes. But what I'm saying is, the bottom line about it is, every year for 7 billion at 5%, and you deduct the 1% it cost you from the European Central Bank, so that's 4%, you're going to get 4% from our government. You actually get 5%, but you're going to pay 1% to the European Central Bank for the time the bond exists. So you're up 4% for doing nothing. You haven't done anything. All you've done is given money that the European Central Bank gave you over to our central bank. But the Irish people are picking up this 4% tab. So that means, say it's a 5-year bond, that means 5 fours is 20%. 20% of 7 billion is 1.4 billion. That's nearly 1.5 billion. It's not much when you say it quickly, sure it's not. 1.4 billion. It's not really much. And what about for the rest of the year? And what about next year? And what about the year after that? 4% tax-free money. Very nice if you can get it, isn't it? Especially when it's your money. All your money. That's what we talk later.